Good morning, good afternoon, and welcome to Develop Your Edge with Anthony Crudele. I'm your co-host, Tom Schneider, CMT with NinjaTrader. And before we get into the good stuff, I do want to remind everybody that futures and options trading contains substantial risk, is not for every trader. You could potentially lose all or even more than all of your initial investment. That's why we recommend you use risk capital. What is risk capital? It's money you can afford to lose, doesn't keep you up at night, doesn't extend your retirement horizon. Also want to remind everybody the past performance is not necessarily indicative of future results, and what we talk about here on this program contains neither trade recommendations nor financial advice. Therefore, should not be interpreted as such. It is presented solely for educational purposes. And with that out of the way, it's my pleasure to welcome back again to Develop Your Edge, Anthony Crudele. Anthony, how are you?
I'm doing great. Hope everybody out there is doing really good as well.
Nice, nice. And we just came off a long weekend. Hope you were well rested and enjoyed that. Had some good weather, hopefully.
Yeah, well, I'm in South Florida, as everybody, most everybody knows that we typically get really good weather here year round, but we're starting to get into raining season, and gonna hurt my golf game, Tom.
There you go. Well, you just got to get out earlier. That's it, right? The rain comes in the afternoon. That's a funny thing about Florida. It's like 4 o'clock. I remember being down there,
Every
rain for a
day.
half hour and then go back in.
But I like trading in the mornings, golf in the afternoons. But that I don't think that this is kind of my off season, kind of our winter. And let's lead right into it when we talk about off season. Today we're going to talk about rollover. I remember the days on the floor when I first started in the S&P pit. There would be a corner of the floor that would just have an area that was occupied for probably 3 weeks every quarter, maybe a little longer, not much longer though. And I used to look at those guys and be like, what are they doing up there, right? As you're a runner or a clerk. And what that was they used to be trading the spread. And one of the most interesting things about futures, one of the most important aspects of futures, is that we expire and we settle at the end of every quarter. Some contracts expire every month, especially when you're looking at commodities. We'll actually go to the gold chart today and show how that expired, and we're into the new month of gold. And so depending on what contracts you're trading, they are either expiring monthly or they're expiring quarterly. Now, why is that an important aspect of futures markets? Well, that's what truly, in my opinion, keeps an open market, a fair market, because some futures are financially settled, some futures are physically settled. And so when you get towards an expiration, unlike an ETF, or maybe you're holding GLD versus gold, gold is actually physically delivered. So at the end of that month or at the end of that quarter, when that market gets towards expiration, it's rolling over into the new month contract. You have the people that either want to take physical delivery or financial settlement, and the people that don't have to either sell that contract or they have to move into the new month. And so therefore at the end of every month or every quarter, when we have rollover, you're determining a true price. Look at it from the corn side of things, the wheat side of things. If you had just this continuous contract, you never had anybody taking physical delivery, how would you truly ever have a fair price of that commodity? You wouldn't, right? And so this is an extremely important part of futures trading. We are where the prices that everything you buy out there in terms of commodities or even things such as gold and of course oil, this is where the price is set. Go back and look to the price of oil when everyone talked about when it went to zero or even negative prices, because those people during that time did not want to take delivery of that product. There was no storage for it. And that just goes to show a true, fairly priced market. So at that point, if you actually had delivery space to take crude oil, you could actually take it in. Some of you may remember when that happened. And the same thing can go for any single commodity. That's the important aspect of rollover. And so when I remember my time watching some of these traders just trading the roll, we would call it, I would say, well, why would they choose to do that? And this is Develop Your Edge. And each and every week, we try to talk about things that help you develop an edge. I knew traders that made millions of dollars trading 1 to 3 weeks a quarter That's it for the entire year because that was their edge. They would trade the spread. Now, I'm actually going to go to a little PDF presentation, which you can download. There's going to be a link in my YouTube description or on anthonycrudele.com for you to download. It's just a very basic PDF about what rollover is. So maybe we share my screen and we go over the basics of rollover. And so I've already kind of discussed the importance of it, right? And we're going to talk a little bit about today about how I saw those traders traded and how maybe you can find an edge trading rollover as well. First of all, just understanding the basics of rollover. Like I said, this is an easy PDF that we'll have for you guys to download, and just understanding it. And this is going to just go over the basic definition. And when we talk about it's closing out positions at the last day. Hopefully you don't wait that long because sometimes the prices can really be, and the volume can be pretty thin on those days, but you have to close out from one contract to the next. That is the point of rollover. Like I said, to me, that's what determines true fair pricing. It avoids the delivery, or the financial settlement too. When you look at the S&P, Dow, NASDAQ, and even a lot of the micro products like micro gold, micro oil are not physically delivered. They're actually settled financially versus the regular gold and regular oil. Those are actually physically delivered. And so therefore you would take a physical delivery on the full contract, a financial delivery on the micro. So understanding that, and that's extremely important. And just to go over a quick example, when I get to the charts here, when we bring Tom back in here and discuss that, if you are a long gold futures contract, and we just saw how gold rolled, and actually I should also point out, they all kind of roll at different weeks too. So a lot of times you're going to have currencies and metals first, along with interest rates, and then you'll working your way into equities. And so equities will close later into the month. So this month in gold, we've already rolled over, but we haven't rolled over quite yet. In equity indexes, they'll roll over in a couple of weeks from now. And so it's important to understand when those rollover times are. So if you are in a position and you want to try and keep that position as long as you can, you have to realize that at some point you're going to have to remove it or roll it in. And the one thing about a roll is that gold rolled over, and I believe that gold was actually at a higher price when it rolled. I'm not 100% sure. Sometimes the price will not be the same. So you're going to be like, well, what if I was long gold at X price and then I roll it into into this market, it's trading a higher price? Well, that was already baked into the cake. So when you go further out in commodities or indexes, the pricing is going to potentially be different. And when we get to the charts, I'm going to talk about trading the spread. That's where the actual edge is. So understand that, 1 month into the next doesn't necessarily mean the same prices. It's not going to be an equal price opportunity. Sometimes it is, but not always. And also understanding, trading the spread. One of the things I want you to wrap your head around, and like I said, we'll do a little bit more of an explanation when we get to the charts, is understanding that if you're buying 1 month or you're long 1 month, you're selling 1 month, buying another month. And so that's really what the spread is. And so when you get into rollover, what happens is you kind of take the technicals and throw them out the wayside. And you say to yourself, well, why would you throw the technicals out to the wayside? That's all I have to go on, Anthony. Well, the reason why is because when you have order flow coming in that has to be done, and what I mean by has to be done means that if I'm long a bunch of gold futures or a bunch of oil futures, or a bunch of S&P futures, and I have to either roll those or take those off because either we have expiration or I have to go into a new contract, that order flow is going to change the dynamic of the market. This is when technicals become secondary and the roll becomes primary. And so when you look at taking advantage of the roll, going back to those guys I would see in the pit, they would realize that a lot of these orders had to be done. So they would either be, selling June, buying SEP, or buying June, selling SEP based upon what was happening within the market. And I say June SEP because that's where we are right now for the E-mini S&P. Sorry about my camera. And then we go to just the final slide is just understanding, the risks are just like with everything else, right? A lot of people, there's ways to either spread it where you just look at the spread where you just have a spread between those markets. So it'll automatically buy or sell that individual market. And so there will actually be a price between the June and the SEP. And a lot of other ways are to leg it in and leg it out. And I always say be very, very, careful when you're doing legging and any type of spreading, because if you leg in or out of 1 month into the next, that price as you get closer to expiration can be very volatile, and it could cost for a lot of heartache if all of a sudden you're trying to do it in the markets. Let's just say gold was trading X price. Let's just say, for example, this is not the case, but gold was trading 1950 and that next month was trading 55. All of a sudden, a big sell order comes in to the front month and it takes it down to 48, and then the other month still stays at 55. Well, that spread just widened, right? And so when that spread widens, you go from trading the spread to all of a sudden having two outrights. And you have to realize that that's the situation. The liquidity can get pretty thin on the one that's getting closer to expiration. And so once again, this is available for you guys to download. Hopefully this gives you a basic understanding of rollover. And Tom, I think we bring you back in now and we just talk about it. I think the first thing I want to ask you, Tom, is as someone who is the CMT, who is the technician, what are your experiences when you're charting markets going into these rollover times?
Well, great explanation. A couple of things I might add is when you talk about spreads, these are calendar spreads. These are spreads from month to month, staying within the contract, meaning we're looking at, like you said, June SEP. A lot of times you'll have contract spreads that go from current month to DECE, like in the grains. But great explanation. As far as, looking at it technically, I think there is very much looking at when we get to rollover, you have to think of the contract as getting to a cash price, whereas that new contract that you're rolling into has some time value to it. And that difference could, like you said, create some volatility if you have to be in the position. If you're somebody like an institution has to have a hedge of sorts, right? As a retail trader, we don't necessarily have to be in a position. We might not even be in a position at rollover, but we have to be aware that that volatility exists, like you said, because those bigger institutions might have to say, okay, I have to have X number of shares or X dollar amount hedged in this market. And if rollover is coming up, I'm going to be aware of that volatility. And so maybe I'm going to get out 1, 2, 3 days before rollover. And there's this kind of like you said, activity that gets a little bit, it's almost like a spinning plate that gets a little bit of a wobble right before that plate falls off the spin, the disc falls off the pin, right? So technically, I haven't noticed, because when you look at the spreads, technically they look there. Let me back up. You're looking at charts at the spreads generally intraday. So really, you just have to be aware that at those rolls, those spreads can jump at any time, and you try to adjust the data there. So you're right. It is a little bit of a different thing right around rollover. But when we look at the spreads, whether it's like you said, legging in, legging out, for me, is creating that chart is more like doing the math rather than looking at the traded spreads. Like you mentioned, the exchange offers some of these spreads as actual instruments, financially settled instruments. So, I'm looking at it intraday more than a daily thing, because of that reason.
Yeah, and when you look at spreads, everybody, the one thing you want to look at when you're looking at your charts or when you're looking at markets during rollover is when you go from, let's just say, like gold right now, and this is where I think you can find edge in trading some of these markets. A lot of times you will see a market make a significant high or low going into rollover, because all of a sudden then that chart changes. It's very strange. You can go back and look at the end of a lot of these expiration times. You will see a market make a capitulative type move towards those expirations. And then really, especially when you get into commodities, the S&P as well, you definitely do see it. But let's not forget here, the S&P, because it's financially settled, what you have an issue is you have an issue of two different pricings and the order flow when you come into an expiration. It's not necessarily about them taking that market off, that hedge off, because they're most likely, if they're keeping a hedge on, they're going to move it. It's really that the order flow and just a little bit of difference of pricing is where it starts to throw off traders. So there's not as much edge there in the indexes, because you really almost want to go to the cash moving averages per se. So for example, let me explain more of what I mean here. Let's just say that the 50-day moving average in the S&P is 4,200. I don't know what it is right now. I don't really watch it. Doesn't matter. But let's just say that that's what it is. And you're looking at the ES futures. And then you go from June to Sep. Well, that Sep 50-day moving average could be 4210. It could be 4190. It could be off. And so what happens is, when you're looking at your charts and the technicals, you're now looking at something to where the pricing has shifted and the averages are different. The VWAPs are different. And they're different because where they're tagged from those previous months, the pricing was different. So with rollover, you have futures markets that are priced differently along the way. And so that's why a lot of times you're going to want to look at a continuous contract. And the continuous contract, what that will do is that will take each of those primary volume months, the primary front month, we'll call it, not we'll call it, it's what it's called, and it'll show you a continuous chart over that. But during that rollover period, like we're entering now in equities and even in gold, you have this difference in charting, in pricing, because you have 1 month going into the next and the pricing isn't perfect. And so a lot of times you're going to get one-dimensional moves in these markets, and that's where I think you can find edge. I actually want to pull up my chart right now and show something here. One of the things that I've been looking at, as you all know, if you follow Develop Your Edge at all, is gold. And what have I said about gold? I said gold is really, to me, it capitulated somewhat to the top back here, where I talked about this on the day where the Fed raised that last quarter point hike. We failed to hold the VWAPs. And then I drew this horizontal line, as you can see here, into the old VWAP, is almost like a gap being filled with a VWAP. And I've talked about this in previous shows. You can go and look at that. So I was looking for almost that runoff higher to runoff lower. And what's really interesting is that low was pretty much made right on expiration, as we have already rolled over into the gold contract. So right now, gold in the front month is trading 1993. The old contract is no longer the front month, right? And so what's really interesting is that especially when you get a commodity like gold, and I should have even probably talked about this even more, but I don't want to confuse people. When you get a market like gold that is physically delivered on the front contract, and you get a bearish look towards the end of expiration, that selling could accelerate and you almost get a capitulation type move towards the end of expiration, as people are now no longer possibly wanting to take physical delivery of that contract. The same goes for oil and other markets. Really, for oil, the most of all of them, and even natural gas. Look at natural gas lately towards expirations, as people are like, I don't want to keep them, I don't want to hold them, right? And so what happens is that market just kind of has a little bit more of a nosedive towards expirations. And that is simply because of the physical element, which is why I've said in today's show, Develop Your Edge, find an edge in some of these physical commodities, and that you're looking at. And if you do get a setup, sometimes long or short, sometimes our market's been trending down, and all of a sudden people are like, I want to buy this into physical delivery, and you might get a run up higher. And so a lot of times you get one-dimensional moves in commodities towards the end of expirations. That is, to me, if anything you take away from today, that's where you can go and find edge. When technicals are lined up for these types of moves with expirations, you can really see a significant move. And where we are with gold right now, which I found to be very interesting, is that we ran off that into those lows. I talked about this trend line. This is the same chart I've had, except I rolled over my NinjaTrader chart now. So you actually have that option to automatically roll it over. And what's incredible is that I had to move the VWAP. And so you can see gold was priced higher. If you remember, 1942 was that VWAP, and now that price comes in at like roughly 1952. So gold basically has roughly a $10 premium on my technicals, meaning that right now, when I look at this low in the old contract, it was probably around 10 bucks lower, and gold is trading roughly 10 bucks higher on a relative basis to where it would be. And so when you look at it, this goes back to what I was saying. When you change into contracts, you're like, oh, 1993, I can't wait to sell this here. Well, in reality, because of the way that the contract was priced in the previous months with the VWAPs and the way all the technicals are set up, gold is actually evenly priced relative to maybe a $10 premium to what it previously was. And so this is extremely important to know when you're trading these, especially these physically delivered commodities.
Well, and you'll see it, Anthony, when there is a rollover and you're using adjusted data, sometimes you might have to adjust your trend lines, right? Because we adjust the data back. We adjust, basically, you're looking at the old contracts in terms of the new contracts prices. So those prices have to be moved up or down. And then you, like you said, it was trading at, what was it, 1942 or whatever. And now you see that line is at 1950 plus. And that's kind of, we just have to be aware that when we adjust data for these contracts, for these charts, sometimes you'll see that behavior after rollover and say, hey, wait a minute, why isn't my trend line fitting that well anymore? Well, you just move it back up to where, or down to where it should be. But that's because new contract forces all that old data to be moved, to be priced in the current contract's price, if that makes sense.
Yeah, no, absolutely. And when we get into the indexes like the equities, a lot of times, so I'll pull up the E-mini S&P here, and actually I'll go back to a daily. A lot of times when we get towards expirations, what you are going to want to look at is where are we relative to the beginning of the quarter? So we've got January, February, March is Q1, right? And so you finish those 3 months, then you get to the beginning of April, and then you have April's the beginning of this quarter. But actually, that is not the case in futures. Okay, so futures are actually going to be a couple weeks back. And so a lot of people will look at the quarter end in equities and say, well, that quarter end is, let's just say it's June 30th, right? Well, the futures during that last couple of weeks is already trading SEP. And so what you have to know is when you look at quarter ends or end of expirations, if you want to look to see where the market's marked, in the future side of things, you have to go back from expiration to expiration. So you watch the futures markets here in June over the next couple of weeks. This is where all of a sudden you're going to start to see the rotation into SEP, which is the U contract, September. And that's where you're going to start to see volatility. And a lot of times, as I mentioned, especially with the commodities, but also you'll see this with the indexes, is where are we relative basis on this quarter? And you could see based on your technicals, and maybe when we get closer to expiration, I'll put some stuff out to see it. It's kind of too early right now. As you look for a majority of the last couple of months, we've almost done nothing in S&P. You start to potentially see a move that could have a one-dimensional type move. And that's going to be very, very close to expiration, especially on the morning of that expiration in the futures. It's different than the options markets. So what you're going to notice is when you get towards expiration in the June contract in the S&P, you're going to see a lot of movement early in the morning on those days of expiration. And that's because, once again, when people have to do something, they start getting in and they start doing it. And they start doing it possibly even early, and they don't want to wait till the last second. And when I mean early, it doesn't mean weeks ahead. It could be hours ahead of expiration. So sometimes you get these moves and you're like, whoa, what was that? And that ultimately is because a lot of people will wait till the very last minute to do a roll, and the liquidity gets a little bit thinner because you're moving from one contract to the next. And if you've got to move a lot of size, all of a sudden it starts showing its face onto the tape. And so when you look at your strategies, always recognize when you get towards rollover for these little different nuances is extremely important.
So, Anthony, going back to the pit and talking about those traders who really only showed up for rollover, were they doing this on expiration, or were they doing this a couple days before expiration as well?
So a lot of them, what they would do is they would carry positions based upon what they thought the spread would do. And I'm so glad you mentioned this, Tom, because the way the spread was traded in the pit and the way it's still traded today is there will be a price difference between June and SEP. And whatever that price is, a lot of times that price, most of the time, will get closer and closer towards expiration. So what they're going to do is they're going to sell 1 month and buy another month. And what they're going to do is they're going to trade a spread. So ultimately, what they're doing with a lot of contracts, and even though it may seem that you're hedged, You're not, because, for example, let's just say that I sold June right here at 42.05, right? And I bought SEP. I don't know exactly where SEP is trading right now. Let's just say that I did, right? What would happen is I'm short June, long SEP. I'm short that spread. Let's just say that SEP is probably trading, let's just say it's 42.10. So it's a $5 spread. As time goes by, if I'm short one, long the other, you would technically be you'd probably be short the spread. And so you'd be looking for that spread to decrease in that specific instance, right? And so what happens is the way that they were trading it, and which is, I think, not necessarily as feasible as it is today, and I'll explain in a second why. But what they were doing was they were taking that big order flow from 1 month and then holding it into that other month as an expiration. So they would want to see the more buying come into the month that they're long and more selling come into the month that they're short, right? And so what happens is they would close that spread, and back in those days, it would be tick by tick by tick by tick, right? Nowadays, because everything is done electronically, what I look for is actually what month potentially could have the stronger move based upon what we're seeing in the technicals. So their move was not really a technical based move. It was more of like trying to trade the spread, trying to trade, short one, long the other, or long one, short the other, which is basically the same thing, because you're trading the same contract, and try to predict that spread would either increase or decrease, right? What I see nowadays is that, to me, is a harder trade, because the algos and the machines do that. And really, you don't want to be, it's hard to even almost chart that. It's not something that I know a lot of spreaders even do anymore. What I look for going into rollover, and where I think the edge is these days, is that one-dimensional move towards the close, right? If you are in a market, I really like, when you're in a bull market, and let's just say that you have S&P potentially starts to get weak towards the end, right? And all of a sudden, we start to get to pricing that becomes very interesting on the SEP contract. And the June contract's getting weaker and weaker. What happens is sometimes you're going to really see a really strong potential sell-off type move that you'll see in the June that maybe is a quick bounce back, almost a capitulation type move, because all of a sudden that pricing rolled directly into SEP. And so everyone in a bull market will like to see, a move lower into expiration, and then ultimately it gets bought up, right? And so you almost could see a little bit of a V-type move. So it's the play that I look for in bull markets, which is what we're in right now, despite what maybe many will say, is I like to look for the short potential squeeze lower, rolling out of some of these financial contracts in June, and move them potentially into SEP. And so that's something that I look at.
Awesome. Thanks. I think we're running up against time. I just do want to address the question that we picked out for Ask DYE. If you have a question for Anthony, you can go on to Twitter. Just tweet out a question to Anthony, and just make sure you add the hashtag Ask DYE and then put in @NinjaTrader. And we will, if we read it on the program, then we will, if you're in the United States, we'll send you something nice. You have to be following NinjaTrader on Twitter, though, to do that. This week's question is from Ryan Lerman. Ryan says, what do you think is the most important skill for a futures trader to have? It's a very specific question, Anthony.
Here's what I say. First of all, I love this question, because there is a difference between a futures trader and a stock or options trader. There's a lot of things that are very similar, but when it comes to the futures side of things, what I've always felt is one of the greatest strengths that a trader can have is the ability to heal from loss very quickly. With very short-term trading, you're going to get nicked, bumped, and bruised a lot more than you are than if you're holding stocks, if you're swing trading, if you're trading options. Even if you are an active stock or options trader, most likely you are not in and out of positions as quickly as you are in futures. I have dramatically taken my positions in futures to a longer time frame, and that to me is multiple days, and that feels like an eternity, right? I mean, you want to hold them, for me, as long as possible, but the problem is that the markets move so much and they're leveraged. So what happens is that most of you are coming in with not a ton of money in the account. And what happens is that you're almost looking for, I don't want to say home runs, but you're looking for the ability to use the leverage and try to make as much money as you quickly can. When in reality, you need to be thinking that I need to be able to really heal from a bunch of losses, and eventually you'll catch one that will really rip and run, or catch a time where it works out really well. So I would say, to me, that's one of the most important traits you have to have.
Awesome. Thank you for that. That's totally agree on that. Being able to bounce back from adversity is probably a really good quality to have if you're a new trader, especially.
Yeah, no one wants to see the scars that I have internally. But quickly, I want to go to just two quick things I want to go over real quick. Number one is, if I can show my screen, we have got the See Me Group Gold Challenge. I've talked about this. I'll be putting out a tweet either later today or tomorrow. Please check that out. And really, to me, you can go to this See Me Gold Challenge June 4th to the 9th. I'll be putting my first video out Sunday night. It begins Sunday night, and the winner gets a 1-ounce gold bar. And so definitely recommend going in, participating on that. I think it's going to be a lot of fun, and I'm going to put out a lot of content supporting trading gold throughout that week. So come check that out. The other thing I want to discuss real quick is a tweet I put out. And one of the things that I look at a lot, and this is something that we have at Place Your Trades, and we talk about event contracts. I'm also, doing a lot of stuff with event contracts, which we trade using NinjaTrader and the Trade of 8 app. One of the things that we look at a lot, and especially in these range-bound markets, it's something that we have that's free. I just want to show everybody it. I put this tweet out, and it's really when you get markets that are very sideways, a lot of times technicals, as I talked about, especially during rollover, can be a little bit trickier. One of the things I look at all the time is we have these stats on Place Your Trades, or 10 years back tested by InvestiQuant, and it shows the stats. And what I put out this morning is for the Dow, and I love looking at this for the indexes because it's a free stat that we have. You can go there and it just helps you understand what has happened on this type of day. It takes into account everything that's happening with rollover and everything, all these different things. And it showed today, if we open down in the Dow, it's a 59.22% probability closing above that at the end of the day. And I thought that was really cool because when I looked at the stats today, that told me to trade the Dow over the S&P. And if you pull up your chart, you will see that the Dow is actually, I think, really rallied off that. So I put a tweet out saying that. And it's just something I want to give to retail traders that is free, that you can go and look at. It's on our membership site, on our website, our dashboard site. And it's just a cool little tool that'll help you understand bias of direction when it comes to gaps. And you can find it at placeyourtrades.com.
Awesome. Thanks for that. That's great information. That gold bar, that if you win, is it you have to take delivery, or can you roll it over to the next contract? Can we do that?
I think that they deliver it. I don't know the whole details of it, but I wonder how they deliver it. Like, are
there
they
you go.
You in the mail? I don't know.
I don't know if you can, but
They got a truck that backs up and gives you that little 1-ounce bar.
1 bar. It's a small truck. Anyway, thanks again, Anthony. It's always great to do this show with you, and appreciate it. Where can people find you other than placeyourtrades.com?
Anthony Crudele on Twitter.
Awesome. Okay, great. And we'll do this again next week. And thanks again, Anthony.
See you, everybody.
Have a great week. We'll see you at bars closing this afternoon with Mike Burke. In the meantime, have a great trading day. Thanks.